Good day, investors. I'm Mike Smith, CFO of PSG Konsult, and pleased to have this opportunity to share with you our latest annual results for the year ended 28th of February 2022. I'm going to run through our overall financial results. I'll then go through our divisional performance, some of our focus areas, run through some return and trading stats, and finally conclude. If we look at our group structure, it's unchanged from previous years. On the 2nd of March, PSG Group announced the proposed restructure to unlock shareholder value, which will result in them unbundling all of their listed investments directly to shareholders. Post the proposed unbundling, shareholders of PSG Group, including the founding members, will continue to hold what will now become a direct interest in PSG Konsult. The PSG Konsult board and management team are appreciative of the supportive and strategic role that PSG Group has provided over the many years. PSG Konsult is well capitalized with an A+ long-term credit rating, a capital ratio of 240%, and a current market capitalization of in excess of 18 billion, which ranks us in the top 100 on the JSE. PSG Konsult operates independently from PSG Group, both from an operational, governance, and financial support perspective. The implementation of this proposed unbundling and change in shareholder structure will therefore not impact our business model operations or financial position. The management team at PSG Konsult remain committed to delivering on our strategy and future growth. PSG Konsult is an advice-led business with a broad geographic footprint throughout South Africa and Namibia. We have 952 advisors operating from 263 offices. 61% of our advisor force are wealth advisors, and the remaining 39% are insurance advisors. If you look at some of our business characteristics, we are equity market dependent, administrative business people and system dependent, not very balance sheet intensive, free cash flow generative, and vulnerable to regulatory changes. We delivered group earnings of 43% above our pre-COVID results for the year ended February 2020, despite our investment in technology and core staff numbers, which increased by 20% and 11% respectively over the past 2 years. The entrepreneurial culture, empowerment, and accountability in the firm continues to attract people with a can-do attitude. Our people are what differentiates us as an organization. Our unwavering commitment to invest in technology and people is consistent with the long-term growth opportunities we see. During the past 2 years, we hired 201 newly qualified graduates, reflecting our desire of continuing to grow our own talent. We have 21 regulatory licenses, 17 in South Africa and 4 foreign, and we continue to maintain good working relationships with our regulators. I'll now run through our financial results. So first off, if you look at the macroeconomic indicators, we experienced an improvement in both local and offshore equity markets. This contributed positively to our overall financial results during the current period. We delivered a 32% increase in recurring headline earnings per share, a return on equity of 23.8%, and we achieved a 17% growth in AUM through a combination of positive net flows, which exceeded 20 billion, and pleasing investment performance market gains was a key driver of our results. In light of our strong financial position and confidence in future prospects, a final dividend of 22 cents per share was declared by the board. Our overall dividend declared this year is 32 cents per share, up 31% from the previous year. Our dividend payout ratio of between 40 and 50% of full year earnings remains consistent with prior years. We have changed the basis of our payout ratio to recurring headline earnings excluding intangible asset amortization, a metric which we believe is better aligned to the group's cash generative earnings, as we also communicated when we released our interim results. If we look at our overall divisional performance, the wealth division contributed 55% of profits during the current period, asset management 26%, and insure 19%. What we're particularly proud of is our successful track record of the 3 divisions, which is highlighted in the 5-year recurring earnings compound annual growth. Insure delivering 23%, asset management 12%, and wealth 11%. If we look at our 10-year track records and some key financial trends, first of all, important to note that we continue to manage and evaluate our performance against an unchanged set of metrics. Our 10-year track record highlights the sequential improvement in all key metrics, a 20% growth in AUM, a 16% growth in core revenue, and our operating margins, which continue to improve as we unlock economies of scale benefits. The sequential growth in earnings and dividends per share for the past decade is testimony to a great firm aimed at carefully managing risk and delivering strong shareholder returns. Now I'll run through some of our divisional performance. First of all, wealth. PSG Wealth managed client assets increased by 17% to 273 billion. This was achieved by securing 20.6 billion of managed client asset net inflows and us delivering good investment performance returns for clients. PSG Wealth was recognized as the Wealth Manager of the Year Large Institutions at the Intellidex 2021 Wealth Manager of the Year Award, and this was for the third consecutive year. We also received the Top Online Broker Award at the recent Intellidex Top Securities Broker Award ceremony. If you look at the wealth business, they have secured 68 billion of managed client net flows during the past year, an achievement we're very proud of. Growth in managed client net inflows continues to improve, as illustrated in the graph. Our sustained investment in digital capabilities aimed at enhancing client experience has enabled our high-caliber advisors to maintain excellent client relationships and service levels, and is a key driver of our success. PSG Wealth continues to advise clients to focus on their long-term goals and to maintain diversified portfolios, especially during volatile and uncertain times. Our wealth advisor force grew by 4% during the current year. 50 new wealth advisors joined us and 29 left, resulting in a net increase of 21 advisors during the current year. If we move across to asset management, our asset management team, who have a differentiated high conviction and active management style, achieved top quartile investment performance, enabling them to deliver market-leading investment returns for clients and earn performance fees. In particular, they benefited from their long SA Inc. stock views. This, coupled with strong growth in multi-managed and single-managed assets, also unlocked further operational leverage scale benefits for our Manco business. The PSG Income Fund achieved first place at the South African interest-bearing short-term fund on a risk-adjusted basis over 5 years at the 2021 Raging Bull Awards. Asset management, improvement in net flows is a function of improved investment performance. Asset management, the top quartile investment returns that they've delivered for clients during the past 2 years continues to improve, and the overall investment performance track record of the business bodes well for future flow prospects. PSG Asset Management continues to engage with clients on the merits of its investment philosophy and the importance of staying in the market throughout investment cycles. If we move on to PSG Insure, PSG Insure achieved satisfactory premium income growth during the current financial year, particularly if one adjusts for the 5.4% reduction in Western's premium income, which is linked to the disposal of Western Botswana operations, which occurred at the end of last year. The division continues to focus on profitable growth with an emphasis on commercial lines type of business, which requires advisor expertise. PSG Insure received the Santam National Intermediaries of the Year Award for Performance Excellence in both the commercial and personal lines category. The insurer advisor numbers remain stable, with 21 new advisors joining the firm and a similar number of advisors leaving the firm during last year. If we now focus on Western National Insurance, they experienced no significant catastrophe events during the last financial year, coupled with the quality of our underwriting practices enabled them to once again deliver very pleasing underwriting results. Our underwriting margins reported during the most recent 6-month period also includes a 30 million release of pandemic BI provision that we didn't require. Our insurance float investment result benefited from recovering markets. At year end, Western had a 6.8% equity exposure. I'll now move on to some of our focus areas. We continue to focus on our top line growth, and particularly as we have relatively low market shares, and we're confident about our strategy and prospects for further growth. Our current focus is to shift away from a pandemic mindset while still ensuring that we maintain a safe working environment. This underpins our ability to return to full engagement with clients thereby enabling us to deliver the strong growth that makes our business sustainable. If you look at how we manage and monitor our business, we continue to monitor and evaluate our overall results by focusing on 3 core metrics: recurring revenues, profit margins, unit of risk relative to return on equity. Performance fees contributed 10.6% of headline earnings during the current year. Operating margins and return on equity continue to improve even if you exclude the performance fees. And the group has no interest-bearing debt, which adds to the group's strong financial position and excellent liquidity. I'll now move on to some return and trading statistics. So this table depicts the investment returns shareholders have earned during the past 16.5 years, where they've reinvested their dividends relative to the JSE Aussie Total Return Index. The next table shows the returns that shareholders enjoyed. We delivered an 18.1% return on equity net of inflation, a stat that we're particularly proud of. If we now move on to some of the trading stats, during the year the group repurchased and cancelled 9.6 million shares at a cost of 110 million. And post the PSG group proposed unbundling, we should get further improvement in liquidity and tradability of the PSG Konsult shares. In conclusion, PSG Konsult has a formidable advisor network in South Africa with a broad geographic footprint that we continue to expand. We have strong governance structures, clear growth opportunities for the business, and a history of delivering superior shareholder returns. Our focus on optimizing risk-adjusted returns per share through restrictive issuance of new shares, I think bodes well for delivering continued sustained investment performance for shareholders. Thank you everyone for listening.